What if I told you that reaching $1 million by age 35 isn't about luck, inheritance, or a six-figure salary? What if it's actually about understanding one simple mathematical principle and then letting time do the heavy lifting for you? I'm going to walk you through the exact path I took to save $1 million by 35. And I'm going to show you the year-by-year breakdown of how contributions and compound growth stacked up. If you're serious about building wealth and achieving financial independence, make sure you subscribe to this channel because we break down these exact strategies and numbers every single week. Let's start with the foundation. The rule of 72 is one of the most powerful tools in an investor's toolkit, and yet most people have never heard of it. Here's how it works. Divide 72 by your annual rate of return, and you get the number of years it takes for your money to double. If you're earning an average return of 12% per year, your money doubles roughly every 6 years. At 9%, it's 8 years. At 6%, it's 12 years. This isn't magic, it's math. And understanding this principle completely changes how you think about starting early and staying consistent. Now, let me break down my actual timeline. I started saving seriously at age 22. At that point, I had no money to my name, but I committed to saving 40% of my income every single year. This wasn't extreme for me because I kept my expenses deliberately low. I didn't have a car payment, I shared an apartment with roommates, and I cooked most of my meals at home. The lifestyle was simple, but the results compounded in ways that seemed almost unbelievable over time. In my first year at age 22, I saved about $12,000. My investments were modest, mostly index funds in a diversified portfolio targeting about 8% annual returns. That $12,000 went into accounts, and it started working for me immediately. But here's the critical part. In year one, my investment growth was almost nothing. I earned maybe $900 in returns. The math was simple: 95% contribution, 5% growth. By age 23, I'd saved another $12,000, bringing my total to $24,000. Now, that first $12,000 had been growing, so I earned roughly $1,800 in returns that year. Still, the overwhelming majority of my wealth was coming from active saving. I wasn't yet seeing the power of compounding, but I was planting seeds. At age 24, something interesting started happening. I'd now saved $36,000 total, and my returns that year were about $2,700. The growth was accelerating slightly, but honestly, it still felt slow. I remember thinking, will this ever actually work? The answer, of course, was yes. But patience is the investor's greatest weapon, and I had to stay the course. By age 25, my total had grown to $48,000. My annual returns climbed to $3,800. I was still contributing $12,000 per year, but now I could see the curve starting to shift. 75% of my growth was still from contributions, but that percentage was dropping. The rule of 72 told me that at 8% returns, my money would double every 9 years. I was roughly 3 years into this journey, so I wasn't expecting dramatic results yet. Age 26 brought me to $60,000 total. Returns that year hit $4,800. I was now getting excited. I could visualize the moment when compound growth would exceed my annual contributions. I did the math. If I continued at this pace, that crossover would happen around year 10 or 11. At age 27, I'd accumulated $72,000. Returns were approaching $6,000 annually. I'd now been investing for 5 years, and while I was nowhere near the $1 million mark, I could feel the momentum building. I stuck to my plan religiously. No lifestyle inflation. No impulse purchases. Every paycheck was automatically divided. Expenses, then savings. By age 28, my portfolio hit $84,000. Returns for that year were about $7,200. I was now halfway through my 20s, and I'd saved about $84,000 through a combination of deliberate contributions and compound growth. To someone on the outside, it might have looked boring. To me, it was the most exciting math I'd ever witnessed. Age 29 was a turning point. My total reached $100,000. That's a real milestone. Returns that year exceeded $8,000. I was now in year 7 of my investing journey, and the rule of 72 suggested I was approaching a doubling point. My original $12,000 from year 1 was worth about $22,000 now. The power of time was becoming undeniable. At age 30, I crossed $120,000. Returns jumped to $9,600. For the first time, compound growth was representing a more substantial portion of my annual wealth increase. I was contributing 12,000, and growth was adding nearly 10,000. The two forces were starting to balance. Age 31 brought me to $144,000. Returns hit $11,000 that year. I was now at year 9 of my journey, and something remarkable was happening. The snowball was rolling faster. My contributions remained consistent at $12,000 per year, but returns were accelerating. The compound effect was kicking into higher gear. By age 32, my portfolio reached $172,000. Returns exceeded $12,000 for the first time. This was huge. That meant growth was now matching my annual contributions. From this point forward, my wealth would effectively be doubling every year relative to my base contribution. The magic was real, and it was accelerating. At age 33, I crossed $204,000. Returns that year were about $14,400. I was 12 years into my journey now, and the original seed money from year 1, that $12,000, was worth over $50,000 through pure compound growth. The rule of 72 had been remarkably accurate. Age 34 brought me to $244,000. Here's where things got interesting. My returns that year were approximately $17,200. That's nearly 1.5 times my annual contribution. The compounding curve was steepening dramatically. If you plotted this on a graph, it would barely budge for years, then suddenly shoot straight up. That's exactly what was happening now. At age 35, my target age, my portfolio hit exactly $1 million. Actually, let me be more precise. It was $992,000 by the time I turned 35. So I rounded up by making one final contribution of $8,000. But here's the important truth. Approximately $600,000 of that million came from actual compound growth and returns. I'd personally contributed about $400,000 over 13 years. The market had given me back 1.5 times what I'd put in through pure mathematical growth. Let me break down the exact ratio for you. From age 22 to 35, I saved an average of about $30,000 per year in actual contributions. That's 13 years times 30,000, which equals $390,000. Actually, I started at $12,000 per year and increased contributions slightly each year as my income grew, so the real number was closer to $400,000 in total personal contributions. The remaining $600,000 came from returns, dividends, and compound growth. That's a 60-40 split, 60% from compounding, 40% from my own money. Now, here's what's critical about this breakdown. The further along the timeline you go, the more dramatic the compounding effect becomes. If I continued this same investment approach from age 35 to age 45, just 10 more years, that portfolio would likely double again, reaching closer to $2 million. But here's the key. I wouldn't be adding much new money in those final 10 years compared to the first 13. The compounding would be doing almost all the work. That's the true magic of the rule of 72 and starting early. Let's talk about what made this actually possible, because I know what you're thinking. Most people can't save 40% of their income. You're right, but here's the secret. You don't need to save that much. Let me show you the math with more moderate numbers. If you save just 20% of your income, starting at age 22, targeting the same 8% returns, you'd have approximately $300,000 by age 35. That's substantial. If you saved 30%, you'd hit close to $500,000. Even at 20% savings, you'd be in the position of financial independence. The timeline still works because of compound growth. The contributions matter early on. They provide the seed capital that the market can work with. But the returns accelerate exponentially over time. This is why financial advisors constantly emphasize starting early. Starting at 22 versus starting at 30 means you gain 9 additional years of compounding. At 8% returns, that's nearly a full doubling of your final wealth, all else being equal. I want to address the elephant in the room. 8% returns is a reasonable long-term average for a diversified portfolio of stock index funds, but it's not guaranteed every single year. Some years you'll get 12%, other years you'll be down 5%. The 8% is an average over many decades. This is why starting early is so crucial. You want as many market cycles as possible. If you only invest for 3 years and hit a bear market in year 2, you might see terrible returns. But if you invest for 13 years, you'll experience multiple bull and bear markets, and the average tends to work out. Another critical component of my strategy was automation. I set up automatic transfers every single paycheck. Money went straight from my checking account into my brokerage account before I even had a chance to spend it. This removed emotion and willpower from the equation. I didn't have to decide every month whether to invest. It just happened. This is one of the most underrated wealth-building tools available to you. Automation plus consistency plus time equals compound wealth. If you found this breakdown valuable and you're starting to see how this could work for your own situation, please like this video. It helps us reach more people who need to hear this message. Let me also address taxes, because this is real-world math. In my case, I maximized tax-advantaged accounts first. I maxed out my 401k contributions, took advantage of my employer match, and used a Roth IRA. These account types either delayed taxes or eliminated them entirely. By using tax-advantaged accounts strategically, I reduced my tax burden significantly and kept more money in the market, compounding. In taxable accounts, I focused on index funds and buy-and-hold strategies rather than frequent trading, which minimized capital gains taxes. The income side of this equation matters too, obviously. I started at around $60,000 per year at age 22, which might have been below average depending on your location and field. But over 13 years, my income grew steadily through raises, career changes, and skill development. By age 35, I was earning roughly $110,000 per year. That income growth is what allowed me to increase my savings rate over time. I didn't start at 40% savings. I started around 20% and increased it gradually as my income climbed. This is actually how most people should approach it. Start with what's realistic, then increase as your income grows. Here's something else that's important. I had no high-interest debt, no credit card balances, no car loans, no expensive habits. If you're trying to build wealth, but you're carrying $10,000 in credit card debt at 20% interest, the math works against you dramatically. Before you start aggressive investing, clear high-interest debt. It's a return on investment to eliminate that debt, and psychologically, it sets you up for success. I want to be clear about something else. My housing situation made this possible. I lived in a modest apartment with roommates, paying maybe $900 per month for my share of rent. If you live in an expensive city or you have dependents, your situation will be different. Your greatest lever for wealth building is the gap between what you earn and what you spend. If you can expand that gap, either by earning more or spending less, or ideally both, you create more capital to invest. More capital invested earlier means more time for compounding. One more factor that deserves mention: I was fortunate to work for a company that offered a solid 401k match. That match was essentially free money from my employer, and it represented thousands of dollars per year that went straight into my retirement account.